Good afternoon, everyone. Can you hear me at the back? Good. Okay, in the last session they said it wasn't carrying so well at the back. It's a real pleasure to be here with my colleague Todd Treslan on behalf of the Saskatchewan Assessment Management Agency. And the topic of discussion today is property assessment. So you're all pretty brave coming out on a Sunday to listen to something like this. Having said that, we do have some very, hopefully very helpful information. We're going to cover everything from the basics in assessment, some of the legislation, some of the principles that we use, and then we're going to move into a little bit more advanced information, such as the different approaches to value. And Todd's got some really good examples to help you understand assessments and explain it to your ratepayers. And then we're going to talk a little bit about assessment trends for the 2017 revaluation, and Todd's got some good information on that, helping you to prepare for the next reval. So at the beginning, I'll talk about SUMA, who we are, our roles and responsibilities. We'll talk a bit about assessment legislation and principles, and the two main valuation standards in Saskatchewan. There's only two of them, and properties have to be valued as regulated or non-regulated. And then we're going to review SUMA's assessment valuation publication, so you understand when an assessment is done, what publication and what information do we refer to come up with that assessment. Todd is going to step in part way, and he'll talk about the role of the assessor versus the assessment appraiser, SUMA's property access protocols, and services that we provide to our client municipalities. Then Todd will talk about three approaches to value, and that's where we get into some math and statistics, so that'll be an eye-opener, I think, to you. And then we'll talk about the 2017 revaluation and get you ready for what's coming down the pipes here in a very short time. And then if you've got any questions, we'd be happy to answer them. All right. In terms of SUMA's main roles and responsibilities, these are set out in legislation in the Assessment Management Agency Act. We are a board-governed agency. We have a 7-member board. I'm going to show you the members in just a moment. But we have two broad-ranging roles, responsibilities. The first has to do with the governance of the property assessment system on behalf of the province. Within that core responsibility, we're helping oversee the assessment of $160 billion in property, and that translates into $1.73 billion in taxes. So it's a fairly large responsibility, and it provides over 50% of revenue to local municipalities. So that's very important for the work that you do. Within this function, we have some specific roles. We have policy. And so we're responsible for coming up with the policy and the procedures that are used in the province of Saskatchewan. We don't just do that in a bubble or unto ourselves. We have a board of directors representing a broad range of this province, and we also have advisory committees. Those advisory committees are made up of stakeholders who have an interest in the assessment system, and so all of our policies go through that channel before they're approved. We also have several other functions, including quality assurance. So that's role confirmation that we do, primary and secondary audits, and you're familiar with role confirmation and annual returns. We maintain a provincial computer system. We manage communications around assessment and offer a safety net for the province. If an assessment service provider is unable to fulfill their responsibilities, SUMA can step in. That's the area I work in. The other main area that SUMA provides service in is assessment services. Todd is the managing director of this area, and we're providing assessment services to 761 out of 769 municipalities. So only 8 urban municipalities are providing their own assessment services, and they have their own staff of professionals that do that work. So within the assessment services function, we're doing such things as annual maintenance, coming out once a year and inspecting properties. We're doing general re-inspections where we'll go into a municipality and re-inspect the entire municipality, all of the physical information, and update that for your assessments. We do revaluations. Every 4 years, we update all the value of property in your municipality to a new base date, and we're going to talk about the upcoming 2017 revaluation. Our CEO is Erwin Blank, and together with Erwin's leadership and this very solid board that we have, they've established for us 4 strategic directions for 2014 to 2017. And I'll just touch on these briefly. To establish a new stakeholder-supported funding model for SUMA, that's the inspection fee that we've just recently brought in, to simplify and streamline to improve the efficiency and effectiveness of the work we do. So we have business process improvements. We're continually looking at the work that we do, trying to find better ways to do it and do it more efficiently. We're using policy, process, and technology to radically increase our property inspections. So our goal is to go from 40,000 inspections per year to 80,000 inspections. When we talk about our policy, we have simplified our residential cost models, and I'm going to talk about that at the very end, but we've really simplified things to make it more efficient when we're applying those models. We simplified our commercial cost models. And on the TI front, we're enhancing our govern computer system. We have a project called Open Forms 2, which is much more efficient for entering property. We're also looking at a web portal to provide services to client municipalities and others. And we're looking at enhancing our GIS capabilities and eventually moving to handhelds. So we can do away with paper in the field and clipboards and so forth, and actually have the records collected in the field and automatically uploaded to our computer system, which would generate an automatic assessment calculation. Purpose of assessments, just at a very high level, you all know this. Assessments provide a financial basis for all of the work that you need to do and that you provide. Municipal services such as police, fire protection, infrastructure such as streets, sewer and water, recreation and libraries, and of course education funding, kindergarten to grade 12. The major benefit of assessment is that it provides local government with a predictable base for funding, and it gives you autonomy over the money that you need to run your municipality. Over time, others have proposed different forms of taxation, but the property assessment system remains very reliable, and I think it'll be around for a long time to come. In terms of assessment principles, I'm going to just touch on these briefly. Just by a show of hands, the folks here, who is newer to local government's role, say 3 years or less? Is there anyone that fits that? So yeah, there's quite a few folks. I'm going to go over these principles because they're fundamental to what we do. The first is ad valorem. So when we assess property, we assess ad valorem, which is Latin for according to value. We measure value according to value in exchange. So how much is somebody willing to pay for a property? And the goal of value in exchange is a one-to-one relationship between a property's value and property assessments. So on an overall level, that's what we're striving for, and that's what gives us equity when we produce assessments. These following principles, if you understand these, you'll have a very good advantage over most people in Saskatchewan in terms of understanding assessment and explaining it to your ratepayers. The first is mass appraisal. All the assessments that we derive in the province are based on mass appraisal. What does that mean? If you're going to have your value property for a bank mortgage, the appraiser will come out and he'll value your single property, and he'll likely use 3 comparables. And he can say what your house is worth. Our job is to value every single property in the municipality. So it's impossible for us to use fee appraisal approaches. So that's why we use mass appraisal. And defined in legislation, I'll just read this out. It means the process of preparing assessments for a group of properties as of the base date, using standard appraisal methods and employing common data and allowing for statistical testing. Todd will get into this a bit more. Essentially what we're saying is that we're using all of the sales and market data available to us. We use common valuation approaches, and then we use statistics to measure that did we come up with an accurate assessment model. And so that's fundamental to what we do. The next concept is the base date. We have to value to a specific point in time for every revaluation. So for example, currently the base date is January 1, 2011. For the next revaluation, it will be January 1, 2015. If somebody comes into your municipality and they've just sold their property, they may expect that sale price to match what's on the assessment. And it's important that you understand that that valuation, that assessment reflects a point in time, and it's updated every 4 years. So we'll talk about that just a bit more shortly. We have a 4-year revaluation cycle. Every 4 years, every property in the province has to be brought forward to a new level of value. So currently, the cycle is from 2013 to 2016. We'll be talking about the 2017 revaluation. At that point, we're going to revalue all the property, and Todd will talk about some trends shortly. Just as long as you can understand that and explain that, that's very important to what we do. A foundation and legislation, we have 2 valuation approaches. We're going to talk about the market valuation standard. Sets out the rules for valuing properties such as residential and commercial property where we have sales and market data and we can value using those, that information. The other is the regulated property assessment valuation standard, and it sets out the rules for valuing properties such as industrial property and agricultural land, and you have to follow the formulas, rules, and principles in legislation and in our manual, and I'll show you a copy of that shortly. So those are the 2 valuation standards. The dominant and controlling factor in the assessment of property is equity. Our goal is that assessments bear a fair and just proportion to similar property. So right at the offset, that is right in legislation, and that's something that we have to uphold when we create assessments, determine assessments. And lastly, board orders. A lot of folks don't know. We have the manual, we have legislation, but there's also the authority for our board of directors to pass specific orders to do with a revaluation. Those are approved by the Minister of Government Relation, and then they have the force of law. Here's the 4 orders that are now set up for the 2017 revaluation. We have the same orders in place currently for the current revaluation. And those are the base date order, and that establishes January 1, 2015 as our next base date. The next one is the market value evidence order. That tells us what market data we can use when we go to value a property on the market valuation standard. And basically it says for this next revaluation, any market data that occurs or arises after January 1, 2015 cannot be used to determine assessments. And when you think about it, the reason for that is when we model for this revaluation, we use all the sales that are available to us, but we have to cut it off at some point in time. We need enough time to determine our valuations and our models to get it to government for preliminary values, which is April 1, 2016, and hence the reason for having a cutoff in an order. There's also special rules for income-producing property. We can go up to May 1st of 2015 if they're not on a calendar, but they're on a fiscal year. Quality assurance standard order speaks to a high-level measure of quality for every municipality in the province, and it's based on an acceptable range for the median assessed value to sale price ratio. So we take all of the assessments and all of the sale prices, we calculate a median, and we're looking again, as I mentioned, for a 1-to-1 relationship. And the standard is 9.5 to 1.05. So for your municipality, you can go onto our website and see what the current quality assurance standard is. And it's broken down by all residential property in a municipality and all other property such as commercial. Having said that, assessors still strive for a ratio of 1. So we're always targeting that 1-to-1 relationship. The final order is the Saskatchewan Assessment Manual 2015 base year order. That is passed by our board of directors after all of the consultation that goes into developing the manual. Once approved by the board and the minister, it has the force of law, and it's used for valuing regulated properties, which we'll speak to in a moment. So these orders are in place for the 2017 to 2020 assessment roll years. Just a quick overview of the foundational components of the property tax system. And to give you a sense of what SUMA does, we're on the far left side of the screen there. That's determining property assessment, which we're talking about today. After we're done, we turn our valuations over to the province. They determine tax classes, percentages of value, and exemptions. They also determine a uniform mill rate for educational property tax purposes. From there, it goes to municipalities. You know the amount of revenue you need, so you're determining your mill rate, you've got your tax tools, and those get applied. That results in the final property taxes payable. So just to point out that the work we do and the area of our authority is the property assessment function, and sometimes people get a little bit confused about that. All right. So just to recap a bit, In terms of assessment legislation, only real property is assessed unless specified in legislation. So we can assess certain resource production equipment at oil and gas sites and mines and the like, but they're set forth in legislation, and beyond that, we cannot assess anything else. Mass appraisal and, as I mentioned, equity are the key features of our assessment system in Saskatchewan. Now, in terms of the 4-year revaluation cycle, this next set of bullets kind of lays it out for you and gets you a good sense of what we're doing. So currently, a Jan 1, 2011 base date stays in place until the end of the 2016 roll year. And then, of course, we're talking about the 2017 reval with a Jan 1, 2015 base date, and that stays in place to 2020. And then you can see already the next revaluation has a base date of Jan 1, 2019. In the policy area where I work, we're already starting to make preparations. It seems like a long ways away, but it really isn't. There's a lot of work to do and a lot of consultation, so we have an eye on that future revaluation. One point I might make, and Todd will probably touch on this as well, the base date's Jan 1, 2015. The values are going to go out in 2017. In previous revaluations, market values have been going up and up and up. So when a person gets their assessment notice, it looks pretty reasonable. In fact, their property might be worth 20% more than what they're seeing on their assessment. Well, now that we're heading into a bit of economic difficulties, you may be in an area of the province or in a jurisdiction where property values are beginning to taper off. So January 1, 2015 could be kind of a high watermark in terms of value. So it's important to understand this concept so you can communicate it to your ratepayers and so that they understand that is in legislation. We have to value it as of that date. But in the next cycle, we're going to bring that forward again and recalibrate. So any changes that occur will be reflected in that next set of assessments. All right, 2 valuation standards. Going ahead here, sorry about that. The Regulated Property Assessment Valuation Standard and the Market Valuation Standard. There's only 2 ways that we can value property in legislation. The Regulated Property Assessment Valuation Standard we'll talk about in just a moment, and the Market Valuation Standard deals with when we're valuing properties using sales. And I'm going to put up a slide with the full definition out of legislation so you can understand what the rules are in legislation for that. Okay, so in terms of regulated property assessments, they're determined according to the Regulated Property Assessment Valuation Standard, and they have the force of law. So legislation tells us the following property types have to be valued using the Provincial Assessment Manual. Those include heavy industrial property, resource production equipment, pipelines, railway roadway, and agricultural land. So the manual has the force of law. It has to be used. We can't deviate from that. The other types of property fall into the non-regulated property assessment valuation standard, and they're determined according to the market valuation standard, and we'll look at that in a moment. That group of property includes residential and commercial, where we have sales that we can use to calibrate the value of those properties. Okay, so here's the Saskatchewan Assessment Manual, and we brought a copy here today if you want to look at it. It's also available on our public website, and this is for the next revaluation. This has the formulas, rules, and principles for valuing property on the Regulated Property Assessment Valuation Standard. If you go in there, there's really 2 groups of property if you want to look at it this way. We're using the regulated cost approach for heavy industrial property, resource production equipment at mines and oil and gas sites, and only RP that's used to extract or produce the mineral or resource to the surface. We're not looking at things in terms of processing or refinement. The costs in the manual are used because these properties don't frequently sell. We don't have 5 comparable sales for a heavy oil upgrader. We don't have lots of sales of pipelines. So they're best valued by the cost approach. And the rates that we use to value these properties are set out in the manual. Also, agricultural land, we value on the productive capacity method. And there's 2 productivity-based models that you'll see in the manual, one for arable land and one for pasture land. We value wasteland at $10 an acre, and we have rules for ag mixed-use land. So in areas where we have a transition between urban properties and rural properties, we often have situations where there isn't zoning, And what these rules allow us to do or tell us to do is to value the first 3 acres according to market valuation standard, and everything beyond that is valued as agricultural land using the manual. Heavy industrial property, legislation tells us it's a regulated property, but if you want to know specifically what types of property in your municipality fall into this category, you have to go to the manual, and the manual sets out these. They include mines that extract a mineral resource, petroleum related industry, ethanol greater than 50 million liters, manufacturing of various products, fertilizer, malt, steel, and so forth, lumber related industries, sawmills and wood production, and power generation, coal, natural gas, and wind turbines. This picture just gives you an idea of the diversity of our industrial portfolio. It is a wide-ranging, high-value type of assessment. So we have mines that cover potash, uranium, coal, sodium sulfate, copper, and gold. We have other heavy industrial properties that include steel and pipe factories, lumber mills, plywood and pulp mills, electrical generation, and so forth. And of course, oil upgraders and refineries in the province, very high-value properties. And just to give you an idea, we assess over 80,000 oil and gas wells and over 5,000 non-well sites within the province. And lastly, pipelines with a total mileage of 11,700 miles within the province. So it's a very big category of property. And for the work that Todd's folks do, that takes a lot of expertise and a lot of on-site work as well. In terms of agricultural land, as I mentioned, there's 2 productivity-based models, one for arable and one for pasture. We're looking at the productive capacity of those 2 types of land, but we do relate it to market. We look at all the sales of agricultural land in the province, and we relate it to the productive capacity rating points through a provincial factor. We have one for arable land and one for pasture land, and we recalibrate it every 4 years. When we do that, everything within those categories goes up by the same amount right across the province. The arable provincial factor currently is $9.77 per final rating point. Pasture's $8.51. Down below in brackets, I put what the new rate is going to be, and you can see quite an increase there. Arable land is going to $21.49, and pasture to $17.45. So that's an increase of 120% for arable land and 105% for pasture land. So Todd will be talking about the 2017 revaluation trends. You can see how agricultural land is increasing relative to other property types. This is a look at some satellite imagery. Our agrologists use imagery to help determine soil lines and to look for land use areas. We're using photos of imagery. We like to have up-to-date product to work with when we're inspecting an RM, but also we're moving to GIS, and we're trying to enhance GIS within our technology infrastructure project to kind of integrate it more with what we do. Okay, market valuation standard. This is all other property that's not regulated, the stuff that sells, residential, commercial, and there's very specific rules in legislation that we follow. As I mentioned, we achieve the market valuation standard when we use mass appraisal. We don't have a choice. That's the first point in legislation. The market valuation standard is an estimate of the market value of the estate in fee simple for the property. So we're valuing the full bundle of rights for an owner. And we want to reflect typical market conditions for similar properties. So we're looking at all the properties that sell that are comparable to the subject property, and Todd will go into more details in terms of how we do our market analysis. And lastly, we need to meet the quality assurance standards set by order of the agency. We talked about that. Okay, 3 approaches to value. Internationally, there's only 3 ways that are recognized to value property. They're used by fee appraisers, and in Saskatchewan, we can use all 3 of these approaches, or tools, if you will. The first is the cost approach, and on the cost approach, we're looking at the principle of substitution. So we're saying the value of a property is equal to the value of the land plus the depreciated cost of the improvements. And we can apply a market adjustment factor to that as well, and Todd will show you that. We have the sales comparison approach, and that's looking at sales, comparable sales to value property. We can do it using a MAF, or we can do statistical measures and multiple regression analysis to build models. So that's another methodology.
And lastly, the property income or rental approach. The income approach uses properties that generate rental income, not business income, but income to the property. We can generate a capitalization rate, and then we can go to properties that didn't sell. We can put on a market rent, impute a market rent, apply the capitalization rate, and come up with very accurate values for income-producing properties. It's a little complex, but when you look at the formulas Todd will show you, it's pretty straightforward. In terms of our assessment publications, we have a few market valuation related publications. The Market Value Assessment in Saskatchewan Handbook. We have SAMA's 2011 Cost Guide, and then we also use two products from Marshall Valuation Services and the Residential Cost Handbook. These are from Marshall and Swift. They set out commercial costs and residential costs. They're industry-wide and accepted, and we use them as the basis for a lot of the costs that we use in the models that we build. All right, this is a look at our Market Value Assessment in Saskatchewan Handbook. Todd's holding up a copy here. This book has information primarily on the income approach to value. It has best practices used by assessment professionals across North America. It brings it all into one place in what we call valuation guides. So we can go into this for properties like retail, accommodation properties, hotel, motel, warehouses, strip commercial, and so forth. This is not a training manual. It's not instructional in that it shows you like a cookbook step by step, but it sets out the broad principles and procedures that we want to follow, and then it recommends the best approach for each type of property. So subject to available data, it may recommend the income approach. Other properties that are more special purpose, it's going to tell us to use the cost approach. So that's one publication that we have to refer to. It's not tied to a base date, so we update it infrequently rather. The last update was in 2012. And this is SAMA's 2015 Cost Guide. This document has information on the costs that we use to value all of our residential and certain atypical commercial property like towers, bins, grain elevators, and so forth, things that we're developing models that are unique to Saskatchewan. They're not necessarily something that we can find and just borrow. So that's in the cost guide. One important thing to note for this next revaluation, when assessments come out in 2017, they're going to be based on a new simplified residential model. So what we did is we took our existing model, which is based on 36 classes of property, and we scaled that back to 7 classes. Why 7? We're modeling after what's in Marshall and Swift, what's used internationally, and it has a more simplified structure, so when we go to a property, we can be more accurate when we classify it and more consistent between appraisers. Previously, we'd be trying to decide if it's a BC or a B or a B old, C old. There was just so many classes, and now it's going to be very straightforward for the appraisers. Just for interest's sake, in addition to reducing our quality classes from 36 to 7, we've reduced our model sequences in our computer system from 75 to 19. It's only 19 steps. And we've reduced the total number of possible choices. When you drop down and you have all the different possible combinations, it was 336, it's now 83. So that's going to make us a lot more efficient at what we do for residential property without sacrificing quality, because we're still going back to those 7 qualities to derive the 36 classes. So we're just bringing it back to where it started in the first place. So there'll be some discussion about that, and you may get questions, but if you do, by all means, let us know. So that's my part of the presentation. I don't know if there's any questions right now. If not, Todd will speak for a bit, and we'll have some time at the very end if you've got some additional questions. Thank you.
Well, thank you, Shaun. Good afternoon, everyone. It's great to be here today. I'd like to sort of start off with, I come from a small town in southwestern Saskatchewan called Beachy. So who's heard of Beachy in here? Who's been to Beachy? Oh, good, good. There, I got some converts here. And if you haven't been to Beachy, this is my sales pitch. You get to go to Beachy, and there's great things happen in Beachy. So if you want to stay for 20, 30 years, it's, we can try and get that population up a bit. So anyway, like I said, it's great to be here today. I'm going to talk about a few different things, so I'm going to kind of cover the gambit here. I'm going to first off start about talking about the role between an assessor and an assessment appraiser. Sometimes that gets confused. Just wanted to touch on that, kind of go over what some of the characteristics are of each of those job positions. SAMA's property assessment protocols. Want to touch base a bit on that to let you know what our protocols are for when we're assessing property. Services that we do provide. Shaun touched on them a bit, but I'd like to go over them in a little more detail. The three approaches to value, we've mentioned them. I'm going to go through some calculations and how we arrive at values of property using those three approaches to value. So get ready, it's going to be riveting. 2017 revaluation trends, and what we want to talk about that is we kind of have an idea of what's going on in the province because we know what the base date is going to be for the next reval, January 1st, 2015. We've been doing some modeling, our staff coming up with values. We have some trends. We want to start talking to you about them. Shaun mentioned some of them already, and we want you to start getting in that mindset of when we're providing values to our clients, you guys, in that May-June timeframe, that we really want you to sit down and look at them closely. Because we want you to look at them, question them, get us to come out and talk to you about them, because I'd sooner deal with anything that you see this year that looks a little funny in those numbers. It's easier to deal with it in 2016 than when we get into 2017 and the assessment rolls are open. The only avenue then is through assessment appeal. So I'll be talking about that here and some of the reports we'll be providing to you as clients. And just to get that, start thinking, because about a year from now, we'll be in the fray of the 2017 reval and rolls will be opening and the new numbers will be going out there. So we'll talk about that and go over some of the trends that we're seeing. Our delivery, how we'll be rolling the numbers out to you as clients. I wanted to touch on that as well. And then any questions and wrap up, and we'll try and have you out of here before 10 o'clock tonight. Municipal assessor and assessment appraiser. And we get this a lot from ratepayers because they don't really sometimes understand what the difference is. So the municipal assessor is typically the administrator for the municipality, but in some larger jurisdictions there is a specific assessor. Their job is to prepare the assessment roll, and many of you in here are how many administrators do we have in the room here? Okay. How many counselors do we have in the room? Good. It's good to have a good cross-section because when we start talking about the 2017 reval numbers, you're all going to be involved in that as well. So the assessor's job is to prepare the assessment roll. The assessor's job is to determine the tax class of a property, residential, commercial, non-arable, arable. That is the assessor's role. And to determine the tax status, taxable, exempt, grant in lieu. That's the role of the assessor when they're preparing their assessment roll, when they're sending it out there. Our staff, the assessment appraisers, assist in one area, and mainly that's to establish, maintain, and undertake valuations for a client municipality. We'll go out, come up with an assessment, and then provide that to the assessor, and then they in turn put that on their assessment roll. We do have one aspect where we get involved in legislation when we're determining a tax status on a property, and that's typically in a rural municipality where there's two different types of uses. There might be a commercial use and an agricultural use. The one I use as an example is a seed cleaning plant where a farmer owns the seed cleaning plant. He cleans 50% of his own, 50% of the cleaning is his own seed. The other 50% is done for commercial purposes to his neighbors, and they pay him to clean it. Then his half, or his 50%, is exempt, and the commercial operation is taxable. That's where SAMA steps in those instances and determines that percentage taxable exempt. And that's the one instance where we get involved in determining tax status. So just a little bit between assessor and assessment appraiser. SAMA's property access protocols, I wanted to touch on that. And we're finding over time people are getting more sensitive to when we're on property. And I don't know if it's just a sign of the times, but it's current legislation gives right of entry to the property to the assessment appraiser. And this right is used with great respect. Our assessment appraiser needs to make a reasonable request to inspect the property at a reasonable time and have ID. So our appraisers in the field have vehicles they're marked with magnetic door signs. All of our appraisers have ID tags, and it's hard for us to phone ahead of time. And if we're doing a re-inspection in a municipality, we'll send out letters in advance. But if we're doing maintenance, to set up appointments, you never know how long it's going to take at each property. So typically we're going and we're cold calling on the door and seeing if someone's there, explaining why we're there, and doing our work. So we go to the door, knock. If there's no answer, we'll gather the information from the exterior and then we'll move on. In some cases, we leave a door hanger if we need to get more information. In some areas, like remote resort locations, we don't tend to leave door hangers because then that's maybe just an indication that a property there's been no one there for a while. So we try to, in urban units where there's lots of activity, we may use a door hanger. If we need more information, we'll leave a door hanger and a business card so that the property owner can phone our appraiser that was there. If the property is marked no trespassing, we'll go directly to the yard site, go to the door, knock. If no one's there, we'll leave the site, and then we'll do our best estimate of the assessment from off the property. And we will not enter gated or secured property. So just to give you an idea what our protocols are there. The services that we provide, one of our main services is annual maintenance, and that's where we get annual changes from the municipality, our client municipalities, or things that we may be keeping an eye on to keep the physical inventory current. And it's important. So this is if municipality, if you have people apply for a permit to build a house, and we'll typically get a list from the municipality of all the changes that have went on, and we'll go out in our May. It's almost ongoing. It starts even for the next 2017 roll. We'll be doing it starting in May of this year, and that'll probably continue till March or April of 2017. And that's to get information onto your next year's roll, and that's what we call annual maintenance. Re-inspections, we also can do a general review of property in a municipality to ensure the physical inventory is up to date. That is one area where we've been lacking in, and we're looking at simplifying our processes, as Shaun mentioned, getting better technology so our appraisers can actually spend more time doing inspections. Because what we found is when we go into jurisdictions that haven't been assessed for a number of years, even though we've been keeping up on the maintenance, there are always things that slip through. Some people don't take out permits. It's hard to believe, I know that, but lots of renovations happen, garages get built, things get missed, and we built a business case. We were finding about a plus 2.2% increase in taxable assessment when we go into a jurisdiction and inspect all the properties. That's sort of the lift we find, and we're finding more than that in some cases in urban municipalities. So it's of interest to get out and do more inspections. We know that you as clients want that, and you guys are actually helping fund our technology initiative to help us to get there. So it's coming, and we want to eventually get to a 12-year cycle where we're looking at every property once every 12 years. That's outside of the ones that we're looking at on maintenance. But just to let you know, general re-inspections, and we're doing more of them. We're getting moving better as we get our cost simplifications and moving with our technology. So we're going to continue to do them where we can. Revaluations, there's often a misconception that every 4 years a new number comes out, so that means we've inspected the property. That isn't the case. We are updating our models, and we're updating our base date, and we're using the physical data that we have on hand, and we're rolling that up with updated values. So that's sometimes a misconception between a revaluation and a re-inspection. But revaluations are legislated to happen every 4 years, as Shaun was mentioning this morning. And another one, it's coming up 2017, just in case you weren't aware. Supportive value, that's something we do for our clients as well, and that's property appeals. Inevitably, property owners have the ability to appeal their assessment each year. They have to have grounds. They can't just say, well, my assessment's too high, but they have the right to appeal their property every year. So if it's appealed, and we can go out and maybe there's a data issue, that type of thing. We can deal with those appeals through an agreement to adjust process where we would agree, the property owner would agree, and the municipality would agree. And if we all sign off on that, the assessor would put that value on the roll and the appeal's withdrawn. It's a lot quicker process than years ago. You had to go through a board of revision for even simple changes like that. For appeals that are going to go to the property owner and SUMA can't agree, then it'll go to the board of revision, the local board of revision. The Board of Revision will make a decision. If either party doesn't like that decision, they can go to the Saskatchewan Municipal Board, who reviews the evidence before the Board of Revision and makes a decision as to whether there should have been a change or shouldn't have been a change. In some instances, on points of law, an assessment appeal from the Saskatchewan Municipal Board could get taken to the Court of Appeal, but that's only, the court would decide whether it's merited to be heard. So that's, we provide those services for our clients through the appeal process. Our regions, we have 8 regional offices at SUMA. We have our Saskatoon region, North Battleford we have an office, Regina, City of Moose Jaw, Weyburn, Melfort, Yorkton, and Swift Current. And then we have appraisers in each of those offices, and they fan out to do the assessments in the rural municipalities and urban municipalities within those boundaries. market valuation standard. And as Shaun mentioned this morning, there are three accepted approaches to value property. There's the cost approach, the sales comparison approach, and the income approach. And I like to talk about these things as they're tools in our appraiser's toolbox to value a property. And if you have the right information for any of these three approaches to value, you can come up with an assessed value on property. The key ingredient in all three of these is sales, and hence the term market valuation. We're trying to hit the market on a mass appraisal basis as of the base date using the sales that are leading up to that base date. So we use the sales in all three approaches. It's the sales are kind of like the foundation of a house, and then it's a matter of what other data we have to determine which approach we're going to use to value property. So I'm first going to start with an overview of the cost approach, because this is the main way we value properties in our jurisdictions. So we start off with land valuation. There's two components to the cost approach. There's a land and a building component. Of course, if you just have land, well, we stop at the land. But what we start out with is determining the average selling prices of land. And we get sales on a weekly basis from ISC and all of our client municipalities. We get about 55,000 sales a year. And then we take those 55,000 sales and we do verification on them. We get rid of the non-arm's length sales. So if I buy something from my dad, we would typically get rid of that sale because it's a family transfer. And there's lots of family transfers in the province. We want to get down to what's considered an arm's length sale. So is anyone in here related to me? Nope, not that you know of. If I bought a property from any of you, that would be considered a arm's length sale. You're trying to get the best amount of money for your property. I'm trying to get the best deal I am. We're interested in those sales, not the non-arm's length ones where there might be something involved in terms of financing or a family relationship. We're looking for the arm's length transactions. So on land valuation, we start out with average selling prices of land and as of the applicable base date. That's the important thing. We're trying to value property as of the base date. So for the current assessment cycle, we're on a January 1st, 2011 base date. So we take all the arm's length vacant land sales, we collect them, and then what we would do is plot them on a map, and we look for units of comparison. Are the lots in this area selling for a square footage basis, a front footage basis, an acreage basis? We then will, by plotting it, see where we can identify where there's different neighborhoods. Is there an area in town that's selling for a higher rate per square foot than the rest of town because it's a newer subdivision, or maybe it's along a golf course or something like that? So we identify our neighborhoods, and over the years, since our first revaluation in 1997, we've got a pretty good idea where the neighborhoods are in our jurisdictions because we've been collecting sales over time and determining neighborhood boundaries. We then determine the base land rates, and that's to select a median base land rates based on the sales in that neighborhood. And I'm going to show you how we go through a calculation of how we determine that. So in this example, I have 5 sales in an area. We know what the sale prices are on these 5 lots. We've verified the sales, they're arm's length transactions. We also know that in this area, we know the size because we've gathered the information on these lots and we have a square footage on each parcel. So what we'll do is calculate a sale price per square foot. And it's pretty simple. It's a matter of the first sale, when they bought that, it was $1.50 a square foot. The 5th sale, $1.13 a square foot. But it's all in the same geographic area. And what we tend to do is look for the median or the midpoint, because there's always, someone's paid maybe a little more than they should have, and someone may have paid a little less than they should have. We call that an outlier sale. We're looking for the midpoint or the average to get rid of those highs and lows. And in this example, we array the sales highest to lowest, and we look for what the median or the midpoint rate is. And in this case, the rate is $1.30 per square foot. So we feel that when lots were selling in that area, as of the base date, they were selling for, on average, $1.30 per square foot. We then test that back. We create an assessment for each of those sales using that new rate. So if you remember the first property that sold, it was 10,000 square feet. We would generate an assessed value on that property of $13,000. Although we do know it sold for $15,000. So we do an assessment to sale check on each sale. And in this case, the assessment to sale ratio is 0.86, meaning our assessment is about 14% below what it sold for. Okay, so we do that for each of the sales. And if you go down to that bottom sale, we're saying that our assessment at $1.30 per square foot would come out at around $9,750. Although it did sell, we know that, for $8,500. So the assessment to sale ratio on that sale is 1.14, meaning our assessment on that one specific sale is 14% higher than the selling price. But what we do is put the sales together, we array those assessment to sales ratios, and we're looking for an assessment to sales ratio of 1. As you can see, the median is 1. So on average, we feel that our assessed values are reflecting the selling prices in that neighborhood. So we tested back to see how accurate we are compared to the actual selling prices. If we had an assessment to sales ratio median coming out at 1.2, that means we're 20% above the market. So we need to go back and fine tune and check where we've done something in our model to make it correct. So just to give you an idea how we come up with land rates in neighborhoods based on the sales. Then, of course, we have these things called buildings, and they happen out there quite frequently. Residential, commercial structures. We have to value the whole property, especially on an improved property. So we start out with a replacement cost new, determined from SAMA's 2011 cost guide that I was holding up earlier when Shaun was talking about it, and that's for residential, selected commercial, or Marshall Valuation Service for commercial. We need to get an idea of what it would have cost to replace that structure as of the base date. So just like if you bought a property and you went to your insurance agent and said, I just bought a property. Some of the things the insurance agent is going to ask is, okay, is it say it's a house. Is it a 1-story or 2-story? How many square feet is it? Does it have a basement? How many square feet is the basement? Is the basement developed? How much of the basement's developed? Is there plumbing in the house? How many plumbing fixtures are there? What type of a heat source does it have? Is there air conditioning? And if you've insured a property, you go through that sequence of the questions. And what the insurance agent is doing is trying to figure out, to come up with a replacement cost on your house so that if it burned to the ground, what it would be worth. Our appraisers do the same thing on a property. And that's when they're out there collecting the data, is to determine what it would have been worth as of the base date. Is there a garage? Is it attached, detached? Is it lined? Is there a deck? So all those things go into building up a replacement cost on a structure. So that's what we do. We then adjust for depreciation, and that's based on the age and condition of the structure. And we have a series of tables we can look at, like if a house was built in 1960 and it's had absolutely nothing done to it compared to the house beside it that was the identical house built in 1960 that's had a lot of renovations and everything done to it, they're going to have different depreciation, just based on that. And they're probably going to sell for a different value as well, because the one that needs more work will probably end up having a lower sale price. So we estimate the depreciation on the structure. We then have to adjust that to the average selling prices for other improvements in the neighborhood. So just like we did on land, we need to bring the improvement values to that market as of the base date. And we use that using a market adjustment factor. And I've got some calculations to show you how we do that. And a MAF is calculated for each sale. And the MAF applied is developed from the median of comparable sales in the neighborhood. So we go through a similar exercise. We gather arm's length improved sales in that neighborhood. So in this example, I've got a house and it's got a replacement cost of $125,000. I've estimated, based on its age and its wear and tear, there's about 20% depreciation. So then our appraiser would come up with a $100,000 replacement cost new, less depreciation. So this is an important thing because we need that when we're calculating the market adjustment factor on this example. So a MAF is calculated for each sale, as I mentioned before. And the MAFs are then arrayed and the median MAF is selected. So the calculation for a MAF is you take your selling price of your land and your buildings. We verified that. We have that number. You take off the land value, which we've established using vacant land sales in that area, and then you're left with what the person paid for the improvements on that in that transaction. We then divide that by the replacement cost new less depreciation that we've determined, our appraisers determined, and we can calculate a market adjustment factor. So in this example, a sale price of $100,000. We know the land would have been worth around $20,000, so that leaves us $80,000 out of that total sale price that they paid for the buildings. We had estimated the replacement cost on this structure is $100,000, so the factor we get, the MAF, we calculate is 0.8. So in the simplest way I could explain that is that if that property had sold on the base date, or like when this property sold, it sold for about 80% of the depreciated cost of the buildings. So if you'd have built a brand new property on January 1st, 2011 for $100,000, based on the market in that neighborhood, you probably could have sold it for $80,000. So it gives you kind of an idea there, just sort of how that market adjustment factor brings the replacement cost down to what the market's saying. And typically smaller communities, we see lower market adjustment factors than larger communities closer to larger urban centers where the market adjustment factors are higher, where people are paying more. There's a higher demand for property, and we might be approaching market adjustment factors of 1. So just a different way to look at, and we can calculate market adjustment factors for commercial properties the same as residential. So just to give you an example, we've got 5 residential properties here, and we've determined that the building sale price was $50,000 up to $75,000 in these 5 examples. We know what the replacement cost new less depreciation is, so we've calculated a market adjustment factor for each of those sales. Again, they range from 0.8 to 0.9. We select the median, which is 0.84. So that's what we feel is on average when properties are selling in that neighborhood, they were selling for a MAF of 0.84. So then we pull that back and we test it. We take our 0.84 and we apply it back to the land rates we've established in that neighborhood and relative to the selling price, and we calculate an assessment to sale ratio on each sale. So for example, sale 1, we come up with a value of $62,000. It sold for $60,000. So the assessment to sales ratio is 1.03, which means that our assessment is 3% higher than what it sold for. If we go down to the bottom, we have a property that we've valued at $80,000 using our model, and we know it sold for $85,000. Assessment to sales ratio is 0.94, which means that we're undervaluing that property relative to what it sold for. But again, we look at the median, midpoint, and we're looking for an ASR of 1. And in this case, our midpoint is the 3rd sale, and it has an assessment to sales ratio of 1. So that's kind of how we come up with land values and improvement values using market adjustment factors in the cost approach. So a summary of the cost approach: to get a property value, you need a land value and a building value. If you just have vacant lot, you just need to come up with a land value. We use the vacant land sales to estimate land value. Buildings are costed, coming up with a replacement cost new, using our standardized procedures, using our manual. Physical depreciation is assigned based on our inspection, and then a market depreciation is also assigned. So that's kind of how we come up with the cost approach values. Overview of the sales comparison approach using multiple regression analysis, or MRA techniques. That's a mouthful. This is the second tool in an appraiser's toolbox. And any statistics lovers in here? Yeah, it's one. Our CEO, Erwin. Anyway, it's a technique we can use to come up with assessments as well. It's a mass appraisal approach which determines the market value through a comparison of valid sales. Again, sales, it's the same sales you would use in the cost approach. Sale prices are used directly to identify value determining variables. That's the important thing, and ultimately calculate assessments. So we can take the sales information with all the physical data we have on properties, run it through a regression calculation, and determine what are the main characteristics that would attribute to value on this sample of data. So for example, if you're walking up to a house and you're thinking of buying it, what would be some characteristics that would be important in your mind to determine the value on that property? You can just throw them out, come up with 4 or 5. New windows, okay. Location, excellent, yeah. Think of the type, what's there. Garage, is there a garage? That's right. Yard, yep. And then the location kind of hinges on that, and is it back onto a golf course? Size of the building is important. Quality of the building, just characteristics. And we have all this information, so we put this all together, and then we can come up with a model that's very close, and sometimes it's only 5 or 6 characteristics determine 85% of the value of any property. So we can use this technique, and I'll show you where we use it. We typically use it in single family or condo residential properties where adequate sales exist. The more sales, the better, because then statistically you can get better results. And multiple regression analysis, MRA techniques, are commonly used to build sales comparison models. So we've built cost models, like I talked about before. This would be a sales comparison approach model. And it's a statistical process, MRA, that is objective. It requires less characteristics than the cost approach, because typically there's a lot less involved in terms of making the model and what's contributing to value. It can be recalibrated very quickly. And there are 3 types of MRA models: additive, multiplicative, and hybrid. And if you're ever having trouble going to sleep some night, pull that up. And start reading through them, you might not even get, well, the additive model is not bad, it's pretty simple, but the multiplicative gets pretty exciting. And the hybrid, well, that's what we do, so then it's really interesting. So when properly specified and calibrated, all types achieve acceptable results. And I'll show you where we use this technique in our jurisdictions in a minute. So we come up with an assessed value of property for land and in the improvements. And the land value considers the lot size and is adjusted for things like neighborhood, land servicing, location factors. And on the improvement side, we can look at living area for the main, the basement, finished basement, various interior features like the things I was mentioning in the cost approach, fireplaces, air conditioning, exterior features like garage, deck, and we can adjust those for neighborhood too. So we can get a lot of information from the sales, and regression can tell us what's driving the value on properties. So when people are buying in a neighborhood, what are the main characteristics that they're paying for, and then we can use that to apply back to the unsold properties. We've built a model, we apply it back, because not every property sells. So where we use the sales comparison approach application in our jurisdictions, and as you can see, we use a hybrid approach, and we use it in our cities mainly, because we've got an abundance of sales. We find when we go out to jurisdictions where there's not as many sales, the sales comparison approach, it doesn't result in as good of assessments as the cost approach. We are looking at seeing if we can model this provincially, where we would have a neighborhood for each municipality, or even neighborhoods within, and we might be able to do that on a go-forward basis. So we'll see if that could be done. The more sales, the better, though. We're using a multiplicative model in Moose Jaw on our condos, and in our provincial high-rise and low-rise apartments. They lend themselves well to this technique. The third tool in our toolbox is the overview of the property income rental approach. And Shaun was mentioning this this afternoon. And it's one of 3 internationally accepted methods of valuing property. And it's the primary valuation approach for rental income producing properties. So what type of properties do you think would lend themselves to being valued by the income approach? Apartments, excellent, yep. Strip malls, yep, good. Where there's rental income, yep, perfect. And the income approach is used for mass appraisal in other jurisdictions, so it's not that it's only used in Saskatchewan, it's used around the world. And it only considers the property or rental income. It does not consider the owner's personal income, and Shaun was mentioning that early. So think of 2 retail buildings and say Shaun's running a business in one and I'm running a business in the one beside it, and they're identical. And you guys own the properties. Shaun might be running a multi-million-dollar business out of his. I might be running one that's half of the business. We're not looking at the business income. We're looking at what do Shaun and I pay for rent on that property to rent it from you guys? Is it $10 a square foot for the year or 20? So we're looking at that, and also the expenses that property, it costs to run that property. So that's what we're looking at. So it doesn't matter what type of business is in it, but if those 2 properties are on the market and they're both renting for the same amount, they probably are going to have the same assessment. So we can develop an income model to come up with an assessment based on the sales that we have of those types of properties. So it's based on the principle of anticipation, and purchasers of an income property pay a sale price now to receive future benefits or a rental income stream. And it accounts for the return on the investment expected by typical investors, purchasers, and of income producing properties. So it's a primary approach used by the industry because the evaluator is using the same technique that someone buying one of those properties is using. When someone goes up to buy an apartment building, they're not just walking up and saying, I like this apartment building, I'm gonna pay whatever they're asking. They're gonna look at they're gonna say, okay, it's nice, there's an asking price for it, but how many units are in it? How much rent per unit could I charge? What are the typical expenses for this apartment building? How much return do I want on my investment? And then they'll make an offer based on that, and so there's a lot of stuff goes into it because they're looking at the income producing property or income producing potential of that property. So we hear terms like capitalization rates, and we can calculate a model, or we can calculate a capitalization rate if we have some variables, meaning properties that have sold and net operating income, and we gather information from owners to determine their net operating income. And we can calculate a capitalization rate on each sale, just like a MAF on the cost approach. So an example here is if we had a property sold for $100,000, and we know that the net operating income is $10,000, the cap rate on that sale was 10%. So we can look at the sales in that neighborhood, array those cap rates, pick the median one, and then we can feel that that's the average cap rate for that area as of the base date. Effective gross income multipliers, we can calculate that. Typically, we use this on our apartment buildings. So we collect information from apartment owners. You know, what are they charging for rent? What are their expenses to operate their buildings? And we can come up with an effective gross income multiplier. If we have sales of apartment buildings and we know what the effective gross income is, it becomes a fairly simple calculation. In this example, a $350,000 sale price on an apartment building, a $50,000 EGI, or effective gross income, results in a 7 effective gross income multiplier. So what that means is we can go to a property now. If Shaun owned an apartment building next door that's never sold, but we know what his effective gross income is, we can apply our factor that we've developed to his effective gross income and develop an assessment for his property, even though it hasn't sold for 20 years. So we're building models based on the sold properties to apply back to the unsold properties. So where we've applied the income approach in SAMA jurisdictions, typically multi-residential, majority of our apartments province-wide, they lend themselves to the income approach. Accommodation, we've applied it to hotels and motels located in cities. Shopping malls, regional and community enclosed shopping malls province-wide in our jurisdictions. And general commercial, we've done it in some of our jurisdictions, and that's for retail, office, warehouse, and that's in Moose Jaw, Yorkton, Estevan, Weyburn, and respective RMs right around those units. And the reason we've done that is because we feel we have enough data to do it. You need to have a lot of data to implement the income approach, and these are areas where we feel we've got enough data to come up with either cap rates or effective or gross income multipliers where we can apply the income approach. But at the end of the day, we're trying to value property, and we're trying to come up with an assessment as of the base date. We have different tools we can use, and we're trying to we have to value every property. If it hasn't sold, we're looking to the sold properties to develop our models. 2017 revaluation trends. So next year is a reval year. And the graphics are in a separate sheet. I've provided them to you so you can kind of look at the numbers rather than trying to squint up on the screen when I go to that slide. And the graphic represents general property types on a provincial basis. The market valuation standard property trends will vary by municipality. So I'll caveat this. These are provincial trends that we've identified. So your specific municipality, if we say residential is going up on average 20%, your specific municipality might go up 40 or 50 or 10 or down 5, so keep that in mind. We'll be providing more information on that to you and I'll talk about that in a bit in the May-June timeframe to your specific municipality. But I just wanted to go over some of the provincial trends we're seeing. And comparisons have been made with current and past revaluations just to sort of show you where the numbers have been moving within the province. So this is the first page on that second sheet that you have in your hands there. And this is showing what we're anticipating the trends are in our client municipalities. So for residential, we're looking at about a 20% increase. And this is the difference in value between January 1st, 2011 and January 1st, 2015. So this is what the sales were showing us. Seasonal residential, about a 15% increase. Multifamily res, 20%. Agricultural non-arable, 105% increase in that 4-year base period. And arable agricultural, 120% increase. So we're seeing a significant increase in our ag land assessments this reval. Commercial up about 45%, and as you can see, more of the regulated properties across the piece, oil and gas mines, elevators, pipelines, and railway rights of way, and sort of where they're shaking out on our trends. So the next slide is a little busier, but it's interesting because it shows you the trends that happened in the 2009 revaluation, the 2013 revaluation, and then the upcoming revaluation in 2017. So the light blue bars are for the 2009 revaluation. And interesting enough, I guess seasonal residential went up 1.65 times in 2009, and oil and gas went up 1.75 times. So you can kind of see there's different shifts between different tax classes and different sectors in the province, even in 2009. Residential was up about 24% in 2009. Then we moved into 2013, and as you can see, residential, seasonal residential, multifamily residential went up, a doubling, because we had quite an increase in residential values in that time period, in that leading up to the 2013 reval. Ag land was in the 44% for non-arable and 47% for arable. So as we move forward into the 2017 numbers now, which are the lime green colors, as you can see, the biggest changers are ag land and pasture land. So it kind of shows an interesting trend over 3 different revals. Things aren't moving at the same rate over every 4-year period. So these are some interesting provincial trends. So revaluation delivery, how are we going to roll out the numbers? We're busy right now. We did our analysis last year. We're still doing analysis, and we're getting the numbers ready to give to government relations as of April 1st, 2016. And we give government relations a line-by-line, property-by-property assessment shift for all of our jurisdictions, and so do the cities that we don't do assessments for. That has to go to government relations by April 1st. That's a legislated target. So we have to get those numbers to them, and that helps them in determining, is there going to be any changes to provincial tax policy? Percentages of value, which then they release later in the year, and I'll touch on that in a minute. We will then deliver preliminary values to you, our client municipalities, after our maintenance in the May to June timeframe. So we'll be rolling out the numbers to you, and I'll show you some examples of what we used last reval and what we plan on doing this reval. And we'll be meeting with you as clients to discuss values as required. So the one thing I want you guys to take away from today is when you get those numbers in May and June, really have a hard look at them. Start discussing them as a council, administration, bring it forward to your council. Start looking at the shifts within your municipality. I'd sooner talk about, if you see anything that looks funny, have us come out. We'll do a presentation to you to go over what we're finding in your community. And let's talk about things. It's easier to deal with things in 2016 than in 2017 when the roll's open, and then the only way you can change an assessment is through an appeal. So if you see something funny, or you want a question, or if you want us to just come out and do a presentation, we're more than willing to come out and talk to you about your numbers after we provide them to you in the May-June timeframe. And so I just suggest you do that and start thinking about that now. An example of what we provided last time, and I know we've got some numbers on there, 2012, 2013, because that was the last reval. So if you can envision this detailed assessed value change report with 2016 and 2017, this will be a line-by-line, property-by-property in your jurisdiction, what the 2016 value was, like this year's value, and what we anticipate the 2017 value will be. So you can look at that on a property-by-property basis and see what the shift is. On the next one, we'll give you a one-pager, and this is an assessed value trend report for your municipality, and it breaks out by tax class what the shift is. So in this example, commercial and industrial, the municipal trend was 28% increase. The provincial trend, we also show that on here because it gives you an idea on a provincial, or how you compare to the provincial trend. Did you go up more in your municipality than the province did overall, or did you go up less? And that's interesting to look at. In this specific example, and it was an RM, seasonal residential was up 60%. Relative to what the other tax classes were. So that's on the assessed value before the percentages of value are applied. And then if we move into the next one, which is a taxable assessed value trend report, this tells you, when you look at it, just a taxable shift within your municipality. So in this example, again, it was an RM, but seasonal residential was up 2.47%, and then some of the other ones are less. So you can use that to start getting a feel for what's happening in my municipality, and do we need to start talking about tax policy decisions, that type of thing. So this is all aimed at getting you guys talking about the changes in your municipality so that there's no surprise in 2017. So again, when you get these reports, I just ask that you look them over, and let's start talking. So after that, we'll roll out the numbers to you. There's some other things that will happen. We'll receive the tax classes and percentages of value from government relations in probably the September, I'd say of September, it might be September, October timeframe. That's on a provincial basis. We then need to recalculate and validate our values, because if they make a change to a percentage of value, we have to recalculate that, We'll continue to work on maintenance. We'll provide our 2017 values to our clients in the January timeframe. And if there's any maintenance left to do after that, we'll provide that as a separate package. So that's kind of the plan for rollout of numbers. Additional resources, of course, SUMA has a website. If you have any, www.sama.sk.ca. We have our online manuals and handbooks, and there's frequently asked questions, so it's good to look there. But you can point ratepayers to our website. And we also have SAMA View. How many of you here have used SAMA View? Good. Good. We're getting good feedback on that. That's where you can go in, go to the SUMA website, and you go into SUMA View, and you can look at any property in our client jurisdictions. There's a map search, and it'll give you assessment information on every property. And it helps out for property owners to look and compare to neighbors and that type of thing. So there's lots of information out there. That brings me to an end of my presentation.